Now, the Dow Jones Industrial Average has certainly had an up and down year. Recently, the index climbed close to 34,000 twice, but a prediction by one market analyst is certainly grabbing a lot of attention. He thinks the Dow is going to maybe hit 40,000 in the next 12 to 18 months, despite inflation, despite these higher interest rates and the looming threat of a recession. When you manage retirement portfolios, are you thinking that far out, or are you more concerned about the here and the now?
I think we're more concerned about the long term for our clients. Obviously, I mean, we try to put policies and portfolios in place that are going to help you to achieve your long term goals. But certainly, it is very difficult to avoid or to not notice what we've been seeing going on in the stock market recently. And so I think that's a little bit of a lofty goal, 40,000 on the Dow. I mean, in one respect, there is a lot of cash still on the sidelines, and people have been kind of flocking to cash and money market investments just because of some of the issues that we've talked about in previous segments about the effect that rising interest rates have on all investments. And the reason being is that now there are better alternatives. There are better fixed interest rates that investors have the ability to invest in. And so if I'm a rational investor and I'm considering investing in a money market or a CD that might be paying 4 or 5%, do I need to take the risk associated with the stock market? And many folks may say no. And so that's why I think we've seen this across the board capitulation of the stock market. But again, there are some bright spots to the economy. Certainly unemployment has been one. We continue to see some of the lowest unemployment that we've seen in our history. We're closer to maybe 3.5%, which actually would generally indicate that that's a good sign for the economy. But in the previous segment, we talked about the Federal Reserve and their aggressive, hawkish policy of taking interest rates up. One of the factors or one of the indicators that the Fed is looking at is unemployment. And counterintuitively, which is why I think it's been so difficult for financial advisors and investors to make rational decisions, is because as unemployment continues to go down, meaning there's a demand for workers in the economy, that actually is a catalyst and impetus for the Federal Reserve to take interest rates up again. And they actually are probably looking for a higher unemployment rate in order to justify stopping the rise in interest rates. And so until the rise in interest rates stop, we continue to see the stock market go down. So that's really hard for me to conceptualize. Is I need unemployment to go up. I need more people out of work in the United States in order for the stock market to go up. And that's kind of the environment that we're in. But relatively speaking, interest rates still are very low. I know people talk about, this is kind of reminiscent of the 1970s when interest rates were on mortgages, 15%. They forget that on the savings side, they were also, 17 to 20%.
Right.
Yeah.
But that was actually a very limited period of time. Those interest rates didn't persist for that long. And so I think the Dow Jones, it is possible, as I'm looking at the numbers year to date, the Dow Jones Industrial Average compared to some of the other indices is still relatively good. I mean, it's only down as of the close Friday, down about 6% year to date. Whereas when you look at the other sectors of the economy, such as the S&P 500 or the NASDAQ, the S&P is down 16. The NASDAQ is down 29. The NASDAQ are the technology companies. So we have been seeing cash flows start to move in the direction of the Dow. For those of you that don't know what the Dow Jones is, it's an industrial average. All the companies, the big earth movers, the companies that build things like the John Deeres of the world, the 3Ms, the IBMs, that build things. They have earnings, generally are well capitalized. Those are the companies that we're starting to see some flows going into. So it's possible, certainly, as people start to shift their investment strategies in the first part of the year away from some of those tech heavy to the Dow Jones, it's possible that we would see 40,000 in the Dow, which is about an 18 to 19% increase. So
Now,
Go ahead.
Correct me if I'm wrong, Chaz. Here, I read recently about the Dow Jones, try to get a better understanding of it, and the stocks that are tied to it are not something that's locked in permanently, right? Like if one is underperforming, they'll just replace it with another heavy hitter.
Yeah, generally speaking, I think it has to do with the market and the cap, the market capitalization and the size of the firm, and if they, based on the number of shares that are outstanding, not to get too technical, and the share price, if the share price drops, below, the market cap, where another company would now be considered one of the 30 largest companies in the U.S. economy, then that would hypothetically replace the company that had fallen out of favor.
I think that's a pretty good analogy as far as, they don't have an emotional attachment as far as, Sears Roebuck, it's a horrible example, but, they've always traditionally been a heavy hitter. We're just going to keep them in forever and ever. And I want to draw the parallel here to your retirement strategy. You may have some sort of brand loyalty to one stock or one index, but you don't want that. You want to take the emotion out of it, which is something we've said many times here on the show, and have a plan that is more analytical and methodical rather than emotional.
Yeah. To that point, Chris, when you're speaking about the Dow Jones, and that really encompasses, there's about 11 different sectors of the U.S. economy. And so some stocks in those sectors, like consumer discretion, those are hobbies and travel, and consumer staples, for instance, also has some companies that are in the Dow Jones Industrial Average, maybe companies like McDonald's. And those are that sector of the economy is where we've kind of been shifting more of our investors' money, towards those sectors that are more defensive, that have an everyday demand, where if inflation, goes up on food, you still have to buy it. Companies are able to pass that cost on to the buyers of those products more so than, let's say, a company where planes or hotels and things like that, where you just don't go this year. So that's actually a good point, where we're actually shifting the portfolio to get them in a position to avoid loss, or take advantage of opportunities that we see inside of that Dow Jones index.
Focusing more on the necessities rather than the luxuries right now may not necessarily be the time to indulge in those, either in purchasing stocks or also, for your retirement plan at all. And there are parallels here, but you really want to have a plan customized specifically to you. And again, like I said earlier, take the emotion out of it, to not be subject to the whims of oh my gosh, all my stocks are underperforming, I have to sell everything right now. No, take the emotion out, have a methodical plan put together. The team at America's Retirement Headquarters, they can help you with that, guide you in the right direction. All you need to do to get started, pick up the phone and give a call, 419-794-3030, or go to the website, americasretirementheadquarters.com.